theory. Get excited. Pretty sure. Let's see if my internet will let me do this. Yeah, it looks like I'm live. Sweet. Okay, I'm muted. Just making sure you're not hearing the stream come through. Welcome to Game Trader. Live. This is the first time I'm doing this. I don't know if you can tell. So this is, I guess, a pilot episode, you could call it. And we're going to talk about investing and trading and all sorts of stuff like that. So, let me get some stuff set up for you. Whoop. Bam. So yeah, welcome to Game Trader Live. Let's see. God, is this going to be that annoying? Is it going to... There we go. So yeah, who am I? I'm Asif Khan. I'm CEO, Editor-in-Chief, EIEIO of Shacknews. If you're wondering what EIEIO stands for, it's Extremely Intelligent Extreme Intelligence Officer. So you need extreme intelligence now, not just artificial intelligence, extreme, right? And then it's Extremely Intelligent Extreme Intelligence Officer. Basically, I'm a big deal. I'm also CFO of Virtue LLC. It's a portfolio company I have been managing for 17 years. So yeah, been a little bit. Why does my opinion matter? Great question, Asif, right? Looks like it's not getting cut off, so this is good. I've been managing investments, both real estate and stocks, for about 17 years. I worked as an investment advisor representative for my own company from 2008 to 2012. And yeah, I just have a very good track record of picking stocks individually. If you want me to start going name by name or line by line or trade by trade, I can. I don't really feel like I need to, but I can. So it's important to clear up a few things for people. What does investing mean? It's basically buying something with the expectation of it gaining value at some time in the future. And most investments require long-term philosophy. So I think it's something kind of important to nail down right now. And then also, what does trading mean? Trading refers to the buying and selling of securities. They tend to be done with a shorter time frame in mind or around a catalyst. You know, people like to trade stocks around earnings or an event. Like, you know, there was a showcase yesterday for PlayStation, or there was like a Nintendo earnings report. Those are the kinds of catalysts that people will try to trade around. So we're going to discuss both investing and trading on this show. So this is something I hear all the time, and I'm just going to cut it off at the pass here. Why not just buy index funds? You can, and I'm not telling you not to, but this is not going to be a show that recommends index funds to anyone. I wouldn't be sitting here as the owner of Shacknews and whatever else that I have without individual stock ownership. And I used an example from the bottom of 2009 in March. The S&P 500 ETF SPY is up 685%, which is a hell of a return. You know, you made almost 8 times your money in about 13 years. But if you held Priceline.com, which is now known as Bookings Holdings, you could have made 5,699%. So that's that outperformance that you get from owning an individual stock versus the broader market. Now, it's important to note, you could have bought Bed Bath & Beyond on that same day and lost 100% of your money. So what I'm saying here is not, hey, look how great individual stock ownership is, you always make money. No, I'm just saying that why own 500 stocks in the S&P 500 when you could own the good ones? So yeah, here's a long-term chart of Priceline.com. And if you could go back in time to the year 2001 and buy it for $17 or $18, it's currently trading for $3,782. And this kind of brings up a larger point that I want to mention. Where we are in this market right now is definitely closer to the highs than the lows. This is a weekly chart a long-term chart of the S&P 500 from the year, I want to say it starts, 95 all the way to present day. As you can see, a lot of the gains have been made. I'm not saying that, sell your SPY, but, this whole idea that, oh yeah, index funds are going to do well over time. Sure, definitely. Especially with accommodative monetary policy, and we'll get into all that stuff over time. But yeah, I just wanted to mention, there's an opportunity cost out there, or, I think people should consider just how much money they're missing when they say, oh, you can just own the market and you don't have to worry about things. The goal of this show is to try to convince people that they can take their financial futures into their hand. Maybe not all of it. Maybe you're in a situation where you already have a 401k where your employer matches, or you already have an IRA where you're saving for retirement and it's already in mutual funds or index funds. Maybe you have enough money to have a discretionary portfolio that you manage actively. And if you do, you might actually end up generating some alpha for your performance. So yeah, that's part of why I wanted to lead off with just, hey, let's not just ask this question, why not just buy index funds? Because you can outperform the market. You'll hear it, and I'm sure people will comment on this video or even in the stream right now saying that you can't beat the market. You can. Tell that to Warren Buffett. Tell that to, and I think, I should just keep the slides going. But, yeah. So next slide. Why am I doing this show? Good question, Asif. In my opinion, the American public has a gambling problem, and it has seeped into the stock market. I'm tired of people treating the market like it is like a roulette wheel, and just kind of shrugging their shoulders whenever things don't go well for them. Or even worse, coming up with conspiracy theories for why their stock didn't work. If your stock went down, there's a reason for it. And it may be manipulation, it may be fake news or whatever, but most of the time there's a reason why your stock goes up or down. And I think acting like the stock market is a casino is a very lazy way of saying that you don't want to learn. And I think there's a lot of people out there who are acting like that. So yeah. And it doesn't help that there's things like Robinhood that have like gamified investment. And I'm not going to hate on them for introducing things like fractional share ownership. That all that stuff's good. 24-hour trading. Okay, it might be good. But if you believe that in the gambling analogy, wouldn't you want to learn how to turn the odds in your favor as opposed to just treating stocks like lottery tickets? That's going to be the goal of this show, is to show you that while there are casino-like elements, no doubt, there's a way to invest in the market that is rules-based and rigid in a way that you would never see at a casino in Las Vegas. So yeah, that's why I'm making the show. I hope you stick around for it. I'm going to focus today on, this show's going to be impossible to hit every topic, because we're doing this once a month. But I am going to talk about two schools of thought in which I use to analyze stocks. There's fundamental analysis and there's technical analysis. Today I'm going to focus on the fundamental side, and maybe next episode we'll talk a little bit more about technical or chart analysis. So fundamental analysis, it's a way to look at the underlying company's results, but also sector, market, economic data, everything. You're looking at facts, right? You're not trying to guess where things are going. You're looking at things we already know. A lot of this data is backwards looking. So we're talking about GDP numbers, employment numbers from the Bureau of Labor and Statistics, or straight up, stock earning results, which you'll see on Shacknews, or maybe even a conference call. All these things that are said on those things, or things that are disclosed in earnings results, those tend to be very important drivers of share price movement. And I actually have a good example of that I can show you today. We got a question from the chat. Do you think there's a FOMO, fear of missing out attitude to the way some people invest? in a post-Bitcoin, post-Apple world and following GME, it feels like people are desperate to get in on the next big thing on the ground floor, which is why people will push random stocks like AMD or AMC and such. To your first point, yes, I do think there's a FOMO attitude. I think when you pull up that, when you look at the chart, right, that S&P chart, that's a lot of FOMO right there. That's people who you could have bought it down here, right, in 09, but when 09 was the generational buying opportunity for a lot of people, it was scary. GM was filing for bankruptcy. We didn't know if the recession was over. So when the deals were there, no one had confidence. Now there's very few deals and the market's very high, and a lot of people have confidence in garbage stocks. I think I don't know if it's a FOMO attitude, Donovan, as much as it is everyone thinks they can get rich quick. And I think that goes back to what I was saying about the broader discussion about America having a gambling problem. Because I really do think that there are people who saw what happened with Keith Gill in 2021, where he took like $90,000 or $50,000 and he turned it into $50 million using stock options and some very smart GameStop investments. People think that they can get rich quick in the stock market. So I do think that's a problem. But I think that those people who think that they can get rich are doing things like investing in nominally cheap stocks, right? Like AMC, for instance. It looks cheap because it's, trading below $10 a share. But I can actually get into why that's the wrong way almost always to look at share price. So I'm glad you brought up AMC because I'm talking about fundamental analysis and things that drive the fundamentals. And they're pretty terrible. So I used we're going to mention these 4 valuation metrics today. These are ways to take individual stocks and Nvidia's trading over 1,000 a share right now. Apple's 192. Sure, 192 is nominally cheaper than 1,000. Nvidia might not be a good example, but there's a way to compare all stocks on an apples to apples basis, or at least to compare stocks within a certain sector on an apples to apples basis. I don't know what this person's saying. Good first time chat there though. Nice to meet you. So yeah, we're going to talk about four ratios that I think are important to looking at stocks right now. Number 1's PE ratio. This is something that you have to be a profitable company to use this. Sorry, why won't it go away? Can you go away? There it is. Thank you. So yeah, there are high multiple stocks and low multiple stocks, and basically when you hear the term multiple, they're talking about the price to earnings ratio, PE. So you take the share price and you divide it by the earnings per share, and that creates a multiple that you can then compare to other stocks. So right now, we're looking at, a lot of stocks are trading at pretty favorable valuations, just in general. The market's high, so that means a lot of stocks are high. Apple, for instance, trades at like 30 times trailing earnings, and they're not growing at all. So we'll talk about how growth affects PE ratios here in a second. But yeah, you can look at PE on a forward basis, so that's based on expectations of future earnings, or you can look at it on a trailing basis. So when I said 30 times earnings for Apple, that's last year's numbers. But this is a way that you can take any stock, if it's profitable, right? If it's profitable, you can do this and compare it on an apples to apples basis. So we're going to be using PE ratios. I'm going to be talking about that quite a bit on this show. Another metric that you can use to value companies is a price to sales ratio. So you take the market value of the stock and you divide it by the sales per share. This is usually done on a trailing basis because we know what the previous 12 months results are, but you can also do this on a forward basis based on like what expectations for sales are going to be. But once again, I'm going to use Apple as an example because it's one of the largest companies on earth. Apple is trading at a 7.8 price to sales and a 30 times trailing earnings multiple. So that's actually kind of high on both fronts. Another way to value companies is price to book valuation. This, I think, is very useful when you're looking at a distressed company because it factors in debt. Basically, you ask yourself, what would the company be worth if we liquidated all of our assets, paid off all of our debt? Is there anything left? And then intangible assets are ignored too in this situation. This is really a liquidation value of a company. And this was used by Benjamin Graham and his disciples, Warren Buffett, Charlie Munger, to create, I'd say, one of the core pillars of fundamental value investing. You look for stocks that are trading at a discount to their book value, because if they're trading at a discount to their book value and they're not losing money, it means that there is an opportunity for the stock, even in a liquidation, to make you money. And Benjamin Graham used this threshold he called the margin of safety. 0.75 times book value was this magical number that he would look at. And if you think about it just logically, let's say you buy something at 3/4 of its book value and it goes back to book value. You made a 33% return. And if they're not losing money, or if you know, here's what I think the impaired book value, like you can look at their balance sheet and you can be like, here's what the impaired book value of this company would be. It's a very useful tool for valuing companies. It's also a way to do an apples to apples comparison of two different companies. I think it's interesting to note, and Apple's obviously a tech company, but they trade at 40 times book value, which is very high. But then you think about the brands they have, the IP they have, all that stuff is factored into book value. So it's not a useful metric for tech companies usually, but because they have a lot of intellectual property, but it is a useful thing to look at when discussing banks or real estate or retailers. But once again, none of this should be done in a vacuum. You should be looking at all the financial statements of a company. I didn't make a slide for them, but balance sheet, which tells you assets, liability, and equity. And then you got to look at the liabilities, like when are they coming due? Are they short-term debt? Are they long-term debt? How much interest are they paying on that debt? All those are important. The income statement, which tells you, here's what we're doing business-wise. Here's how much revenue we had. Here's what the cost of those sales were. Here's what our earnings were or our loss is. Income statement's important too. And then statement of cash flows is also important, because sometimes a company may have negative operating cash flows, but positive investing and positive financing cash flows that end up offsetting their burn rate. Because if you're looking for distressed companies, which I tend to do, they may not be in the best financial condition. So looking at cash flow and the rate at which they're burning it is something very useful. And thank you for the follow. We're going to keep this train rolling. And I mentioned this already, but the PEG ratio is the last one I'll mention today on this show. But it's a way to look at... Oh, I spelled rash in there. Sorry. First week here, folks. So PEG ratio, it's the PE ratio, and it factors in EPS growth. So EPS stands for earnings per share. This is like you apply the growth rate of the company to the existing multiple, the PE multiple, and you divide it by it, and you say, okay, well, what's going on here? So I mentioned Apple, and obviously, like, I've used it a lot as an example today, but it's trading at 30 times forward earnings, or 29.15 times forward earnings. But the most recent quarter was a down year-over-year earnings. It decreased by 2%. So you're paying a pretty hefty premium if you're buying Apple here for a company that is not really growing at all. And that's with the share buyback. It's interesting times over there at Apple, for sure. So let's look at some charts. Sorry here. Give me 1 second. What's the next slide? Yeah, we'll get to my last slide later. So yeah, I'm going to look at some charts because I posted a thread to our Shacknews chatty forum. I said, hey, what do you want me to look at? What do you want me to talk about? So I have some requests from the chat. Someone was asking about Monster Energy Drink. That stock no longer exists, but I just want to mention that I've been a Coke shareholder since I was 12. And yeah, not a bad stock. It's been a nice study in buy and hold here. My thesis, which I think it's important to always have an investment or a trading thesis when you're committing capital to something, not just I think stock go up, but my thesis at the time was that Coca-Cola, and this is a 12-year-old, me as a 12-year-old, Coca-Cola sells an addictive product, and I think that I thought that was a good business model. And I also enjoyed Coca-Cola. So sometimes it can be as dumb as that, but it's still an investment thesis. It's better than just saying line go up, so I buy it. Let's see what else we got here. Let me look at the thread. Someone wanted me to, we got a lot of requests for like deep dives into different sectors. So I'm probably not going to talk about the healthcare sector this week, but someone asked me to talk about the semiconductor industry, and I think that's a really interesting topic. So we're going to do that this week. Maybe it'll be like once an episode, we'll do a sector analysis or something, right? So this week, I can't think of a more important sector in the current economy than the semiconductor industry. So we're talking, just look at it. It's at an all-time high that was hit earlier this month. It was, 4 days ago. The SMH, which is an ETF for the semiconductors sector, hit an all-time high just 4 days ago. But you got to look at the components, right? We're talking Taiwan Semiconductor, who makes most of the chips that we use here in America. You're talking about Texas Instruments. They make a lot of the semiconductors that you see in vehicles, which cars are becoming more and more like computers. We're talking about AMD here, which AMD stock is not at an all-time high right now. It's sold off on its recent earnings. It's kind of been hanging in there. But they've done very well for themselves competing with Intel, but also competing with NVIDIA at the same time. It's funny, AMD still feels like the Avis of the semiconductor industry, but they've really done a great job of executing over the last decade. This is another one that if you want to go back in time and slap yourself, this stock traded for less than, it was $2 in January of 2009. It hit an all-time high in March of this year of $227. So yeah, that's a pretty nice return. Even at its current price of $166, if you bought it for $2, you're probably doing pretty great. The problem is a lot of people, when you buy something for that low, you make the mistake of selling it even though your investment thesis is still playing out. So yeah, AMD is another one of those. Obviously, NVIDIA is like the hottest stock in the entire market. At least it was up until earlier this week. This is a stock, forget 10 years ago. You could have bought this stock in January at the beginning of the year and doubled your money in 5 months. So yeah, NVIDIA is really interesting. Talk about a company that we cover a lot of earnings reports here at Shacknews, and we're covering a lot of tech companies now, and tech companies are super focused on AI. And it's like a running joke on our staff because we're on Discord when we're listening to these earnings calls. Everybody is buying something from NVIDIA right now. Apple is working with NVIDIA on their cloud stuff. Google is powering their cloud stuff with NVIDIA. Amazon is working with NVIDIA. Microsoft and OpenAI are working with NVIDIA. Tesla is using NVIDIA H100s to help train its computer vision neural network. So it's like everywhere you look right now in tech. Facebook's doing their AI thing. Guess who they're cutting checks to? NVIDIA. So it's like all roads kind of lead to NVIDIA right now, and I do think it's a fascinating time for the stock because even though it's trading at $1,100 a share, it's growing rapidly. Like, I'm talking about triple digit earnings per share growth. So, we're talking about Apple trading at 30 times earnings, and oh boy, that is expensive. Because, you're factoring in Apple's brand, its track record, all that stuff into why it's trading for that premium. But then you go look at Nvidia. I just told you it's growing earnings at like 200% year over year. It's only trading at 42 times forward earnings. That's actually cheap if you look at it from a PEG ratio standpoint. It's actually cheap. So even though Nvidia looks very lofty at these levels, I think it can go higher. And full disclosure, I do have a family member in one of the portfolios that I manage that does own Nvidia. But that's why I think it's going higher. And we have a ton of evidence that it is. Basically, they're very diversified, but they're very good at scaling up whatever the it thing is. And right now, AI is that thing, and they have demand for like 6 to 18 months that they can't fulfill. They literally would be making more money if they could make more AI chips, or at least help in the production of that. Other thing I want to mention about Nvidia, why I think it's just a fascinating company, I'm talking about 75% gross margin on their revenue. That's every dollar of sales, they're making 75 cents of profit. So at some point, I don't know when, but at some point, they're going to face some very difficult year-over-year comparisons, probably a year or two from now. But right now, things are going very well over at Nvidia. And I saw someone in the chatty thread asked about the CHIPS stimulus program and also how it would affect Intel. I want to say Shacknews reported on Intel. I want to find this article real quick. Yeah, they disclosed a $7 billion operating loss in their foundry business. And this is from 2023. So this idea that they can make money making chips in the United States might not be true. So I'm talking about Intel here. And you'll notice, like, look at this chart. Look at Intel's chart. This is the weekly chart. Look at Intel's chart. Now look at Nvidia's chart. Look at Intel's chart. And now look at AMD's chart. Intel is has had their lunch eaten. Oh yeah, there's one other company I want to mention that's like, I would say at the core of this revolution. It's ARM Holdings, which hasn't really been publicly traded for that long. It was held privately. Nvidia tried to acquire them, and an antitrust, I think it got blocked by Europe or something. So yeah, ARM Holdings is basically every chip inside of every device that you're using right now, smartphones, tablets, Macs, Nintendo Switch, they're all running on ARM chips. And ARM's a fabless company. They just license out their tech. But yeah, you look at ARM Holdings, you look at another company in the space that I think is doing better than Intel, Qualcomm. Qualcomm is making the radio transmitters for devices and stuff, and also they make their own processors that compete with ARM, or not compete, but they make phone processors for non-Apple devices. But yeah, Intel really missed the boat on two things. Intel missed the boat on the smartphone era almost entirely. Asked Relic asks, should I invest in waffles or pancakes? Man, I got some bad news for you. Let's look at the Denny's chart real quick. I love Denny's, you guys. I don't know about you, but Denny's and me are like this. And their stock is doing terribly. And, normally when I see a stock that, it peaked at 24 a share back in 2019. This is a stock that this entire collapse that you're looking at here was the COVID lockdown. And I don't think everyone made it back to Denny's after COVID. We lost our Denny's in Canton. There's only one Denny's in Canton now. We lost the good one. So yeah, I don't know about waffles or pancakes right now. It might be a tough time to invest in waffles and or pancakes. But yeah, Denny's, not a stock I would buy here, but I love them as an American institution, and I'm worried. because they have a lot of debt. So yeah, sorry, you got me off track. We're talking about Intel. Intel, David knows all about where the good Denny's was in town. But yeah, Intel, we're talking about a $30 stock. You know, it's I think Intel is a textbook value trap. I don't know if they're ever going to be able to turn around the problems that their company faces. Because they're so levered to the x86 and that framework going forward, or the Atom processor, or like whatever, at a time where everyone's making ARM chips. And they're not even able to make chips in America at a profit. They lost $7 billion last year. So do I think that some sort of subsidy from the Biden administration is going to help? No, I don't. And I think by the time they build whatever factory that they got greenlit to build, there may be no demand. Like, the demand outlook could have completely shifted by the time that factory goes online. So I do think that Intel's a bit too late to really turn it around. But if we're looking at the fundamentals, this also trades at 28, 30 times earnings, at 2.3 times sales, and at 1.2 times book value. So obviously it's lower than it used to be, but apples to apples, I would rather own almost any other company in the semiconductor space right now. I would rather own Nvidia. I know it's a higher PE, but we're also talking about triple digit earnings per share growth at a company versus, kind of mediocre. I think they've even posted losses at times. So it's been a rough few years for Intel. I don't see any reason to believe that there's some sort of turnaround coming for Intel. So, and also, like, when you have the broader semiconductor industry at all-time highs, and your stock is basically bumping around 52-week lows, there's something very wrong at Intel. And I think it's not, maybe it's not the people who are there now managing it, but it's about a decade and a half of really mismanaged risk and taking on acquisitions that didn't really make any sense. I believe they bought Symantec, and then they also bought a computer vision company for like self-driving. What was it called? So yeah, I don't know. This is my point about not buying the S&P 500, by the way. This is a member of the S&P 500, this stock. I don't want to own it. So like I said, if you like semiconductors, just go buy the SMH if you want to own if you want sector exposure. But why not just buy the best? Why not just buy ARM, AMD, Nvidia? Like, why not just go that route? Why own the crappy companies? That's a question I'm going to ask a lot here. Is like, okay, so the stock's down and the results are bad. Why do we want to be the hero? Why do we think we know when we're like, nope, it's now. This is the time to buy Intel. I see no evidence that it is. I don't know if they've completely missed this AI move. I think it's premature to say that, but Nvidia was ready and Intel was not. And Nvidia was ready for the crypto mining rush, and they profited off of that too, And back when VR was hot, Nvidia was there. So I just think that one company does a very good job of kind of jumping trends, and the other one, I don't know. I think it's becoming a legacy company in the tech space. I don't know if we're ever going to see Intel go back to those highs, which the all-time high of this stock was in the year 2000 at like 75 a share. And we're talking about a stock that's sitting here at 30. So yeah, but I think I think the CHIPS Act stimulus program is a bunch of kabuki theater by Joe Biden and his administration. I don't think it's going to lead to much, at least from a financial standpoint. Maybe it'll create some jobs, and that's good. But yeah, I don't know if I would be handing Intel contracts. I'd probably look to work with other companies, maybe even like Texas Instruments or whoever. I know it's a dicey thing, but like there are better foreign chip makers out there. Maybe we get Taiwan Semiconductor to move over here and start building some chips over here. But I think there's a bigger problem that it's just hard to manufacture stuff in the United States for cheap. It just is. And as long as China's out there and Africa is now kind of coming up and India is now kind of scaling up, there's going to be a lower cost competitor out there. So I'm not sure if I would rather invest in the fabless companies like ARM, Qualcomm, and NVIDIA who license out their tech to other OEMs than to buy the OEMs or to buy even Taiwan Semi here. But I would, if I had to, my family, we own NVIDIA. But if I had to buy like a basket of chip stocks, it's those ones I mentioned. ARM, AMD, Qualcomm, NVIDIA, maybe Texas Instruments. I think that would be a better way to go than to try to be a hero in Intel. But my point is, do the homework in Intel, and whenever, if it ever happens where you're like, look, I think the turnaround is actually happening, buy the stock. But I don't think we've seen any evidence of that yet. But that was a great suggestion. So thank you to There Can Be Only One Cat for that suggestion. This person asked me about index funds. He's moving from one index fund to another. I have nothing to say about that. I'm not going to opine on ETFs or the benefits of mutual funds versus mutual funds. I don't want to own 500 companies because right now I own the least amount of stocks I've owned in like 10 years. Because you'll notice a trend from me. I'm not going to recommend many stocks to buy today because I don't really see many that are out there that are of a decent value. Let's see what else we got here. Someone just wants me to talk about Tesla. Let's take a look at Tesla. That's a downtrend. That is an established downtrend. It's been going on almost since he acquired Twitter. Isn't that weird? I wonder how that works. But yeah, everything's going wrong at this company right now. He's fired a bunch of people. They were set up to like take over the charging economy in the United States. And then he fired everyone in the charging division, including the head of it. Apparently she didn't want to fire people, and she got fired for not firing people. And he's having a bit of a temper tantrum in the entire company right now over his compensation plan that's being voted on again, which is a little weird. Shareholders approved it. The court found it illegal, so now the shareholders have to approve it again. It's very strange. But if he wasn't such a douche nozzle, the CEO, Elon Musk, the stock probably wouldn't be in this predicament. The company wouldn't be in this corporate governance predicament. And I think shareholders would be much happier. You're talking about a stock that was $400 a share in late 2021, and it's currently trading for $177. It is the worst. It's one of the worst performing stocks in the entire market this year. And it's just, I see no evidence that it's going to stop anytime soon. We're seeing the cost of insuring a Tesla Cybertruck is doubling. And they've had to recall a bunch of them. The build quality on the Cybertruck really does appear to be terrible. So yeah, I think there's more tough times ahead. I do think that Tesla has a cult following, so there will be people who just buy the stock indiscriminately. So there's a chance that it'll run back up into this like 230 range before the end of the year. I think that would be just another opportunity to sell the stock. I own it at a much, 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 much lower level than where it's currently trading. And as a shareholder, I'm not happy. I'm not happy about anything. I think the canary in the coal mine for this stock was when the CFO, Zach Kirkhorn, announced that he was leaving on the third quarter conference call. I think it's one of these, can you imagine trying to be a logical person working with Elon Musk above you? and just the knowing that at any given time he could tweet something that would decrease demand for your product. It must be really frustrating for a lot of people over at Tesla, because I know I own 2 Teslas, and I bought another one that I still haven't gotten delivered. But yeah, like it's I don't know. I would not. I guess if you're asking me what I think of the stock here, I would not buy it. Not until there's evidence that it's done going down. It did trade inside month during May. So that is, I guess, a sign that equilibrium is attempting to be reached. So next month, you would want to watch for a breakout. Look at me. I'm going to give you some levels to watch. A breakout above 187.56 would be a buy signal on the monthly chart that would be active for all of June. And a breakdown below 167.75 a share would be a sell signal. So you could short it or buy put options if it breaks below that level. Now, I'm not predicting anything, but just based on the evidence we have and all the earnings reports that we've already seen from out of Tesla, things are not going well this year. The Cybertruck scaling has hurt their margins. The Gigafactory ramp in Germany is not going as well as planned. And the Mexico Gigafactory, they basically stopped talking about altogether. There may actually be a demand problem at Tesla now. I was saying NVIDIA doesn't have a demand problem, they have a supply problem. Tesla may have a demand problem because car brands are fickle. They're cool until they're not. And Elon is definitely making it less cool by the day to have a Tesla. I saw a picture of someone, they were driving around I think it was a Model Y, but they put an Audi logo on the back of it. So that was something. Let's see what else we got. I think that person also asked for NVIDIA. We already talked about NVIDIA. Let's see what else. What else did they want? Oh, Nintendo. I know a little bit about this stock. Nintendo reported earnings in May, and they were okay. Their financial year 23 numbers were fine. They actually grew last year. But they announced, we're in this time where everyone thinks perpetual growth, right? Everything's going to grow forever. And stocks are being valued like that, and companies are managing their results like that. They're cutting jobs, and they're implementing AI and all that stuff to improve their margins and to keep the growth going, right? Nintendo just announced guidance that they expect profits to fall almost 50% on the year. And that makes sense, right? We're talking about the year 8 of Nintendo Switch as a platform. That's old as hell. They still expect a profit. They also are cutting their dividend by 40% because they pay their dividends out of their profits. So if profits decrease, dividends decrease. So you would think like a dividend being cut and really bad guidance, like, given how everyone else is reacting to stocks who are cutting jobs and implementing AI going up, it seems a little strange that Nintendo was actually up this month. But yeah, for the month of May, Nintendo had an outside bar to the upside, up 11.29%, which is great. So I have here's some technical numbers for you to watch. You want to look at a breakout above 13.82 a share in June for a buy signal for the month of June, and also a sell signal below 11.75 a share if it breaks down below that. But there are some notable uptrends that are still in place that date back to before the Switch launched. So I like to call this lower band the Switch momentum bar, and then this was like the real Nintendo. This is post Nintendo Switch launch here. Last year we saw it bounce right off of that uptrend when the stock traded almost to $9 a share. That was a great buying opportunity. The stock went up to 15 in about a year. So yeah, you could have made an over 50% return on Nintendo in a year, on the back of the Mario movie and all that stuff. So I think what's going on at Nintendo is that some shareholders are starting to realize that, like, you might be able to own this not just for one product cycle. This may be a multi-generational thing happening at Nintendo now, where they're making mobile apps, they're making movies, they're doing things. I don't know. Did you see how much that Lego Deku tree costs? Can we talk about this for a second? The Lego Deku tree costs $300. You know what else costs $300? The Nintendo Switch. So I think Nintendo's doing a very good job of, like, taking advantage of their licensing money, right? Be it movies, toys, whatever they're doing. They have a newfound respect for what can happen if they start monetizing their IP, more aggressively. And right now we're talking about the IP licensing division's like 5% of revenues. What if it goes to 30 in like 10 years? What does this company look like at that point? And then obviously the other thing that's keeping the stock going right now is Switch 2 hype. The CEO announced that it was an announcement of an announcement, but they're going to announce the Nintendo Switch 2 sometime before March 2025, the end of March 2025. So we know that it's coming. So I think that people are kind of hanging on for that. I will point out, just as someone who's owned the stock for a very long time, I do think this is the most important, console launch, I think, in the history of Nintendo. If they get this wrong, which is very possible, it'll hurt the stock, whatever. But if they get this right, this would be huge for them, because the idea is that they're going to take the Nintendo account and let it live on beyond the Switch. So if you'll be able to transfer purchases on a Nintendo device for kind of the first time ever, generationally. And I think there's going to be a lot of overlap between what Nintendo launched on the Switch and what will be, maybe it'll run better on Switch 2. So I think, like, the days of Mario Kart 8 Deluxe selling millions a quarter probably will continue into next year, which is just hilarious because that game has sold over 60 million units, and it's a Wii U port. So yeah, at a time where Microsoft and Sony keep tripping over themselves in their clown shoes, Nintendo's doing very well. So yeah, I got nothing bad to say about the stock. I do worry that there is far more competition in the handheld space now than there was 7 years ago. So I do think that that's a risk. They also, I hate to use this term, but it's hard to describe it any other way. They were at the right place at the right time during COVID. They had plenty of supply of Nintendo Switch hardware, and they released this comfort food game during the lockdown that was Animal Crossing New Horizons, which sold over 40 million units. Most successful game in the franchise's history, but it's also created like a whole new generation of people who, like, Nintendo was there for you at one of your darkest times, society's darkest time. So I do think that they deserve credit, but also thinking forward, I don't know if there's going to be another lockdown in another generation that would cause another spike, because, demand for the Switch really did spike during the pandemic. It became a more valuable device to people, with a bunch of people sharing the living room or whatever. Having a hybrid device like the Switch really came in handy. But now there's Steam Deck, and there's ROG Ally, and there's some Lenovo thing, and yeah, there's a lot of competition. Something to watch. So I am a bit worried going into next year, and it feels like the market isn't for Nintendo. But I also think, like, Sony and Microsoft are really helping out here by just showing how not to go into your fourth year of a console. But yeah, Nintendo, I still like it. That should surprise nobody. And yeah, I own it. Owned it for a long time, still own it. And I will update people if I exit it entirely. And I want to talk about a stock that I just saw this news, and I thought it was interesting because it kind of highlights why shares move the way that they do. Dell had an interesting week. They This was on like a conference call. Tony Sacconaghi, he kind of pulled back the curtain on the financials of Dell. They were like, our server revenue grew by 1.7 billion. So Tony was like, so basically all of your revenue growth came from AI, but no operating profit came out of it. So he's like, does that mean that you made $0 off of the $1.7 billion of cloud services revenue? And they're like, yeah. So the stock fell 20% in a day because of it. So that's how fundamental news will come around and just clock you upside the head. But yeah, I think we're going to see an emperor has no clothes moment for some AI companies. Not all of them, but I think some AI companies need to come to grips with the fact that they're spending a lot of money and we're not entirely sure how they're going to profitably monetize it. You can have revenue for a service, but is it profitable? You have revenue for a product, but is it profitable? Very important thing to pay attention to in all these AI companies. Because like Microsoft may be the closest to running their AI at a profit with Copilot and everything they're doing around that. Amazon may get close to that. I don't think Meta has even said they have no idea. Probably 3-4 years before they have some sort of a service that actually makes money off of AI. And OpenAI is basically a black box when it comes to the profitability of that sector. And that company specifically and how they operate. But yeah, AI and semiconductors are kind of a push-pull in this market right now. Because for the singularity, if you believe in the singularity, for the singularity to take place, we're going to need way more investment in the semiconductor space. So we'll have to keep an eye on that. Let's see. Some people wanted me to, they asked me about Disney. It's just a bunch of like random stocks. I used to own Disney a long time ago. Well, they had a good day. Stock went up. It's been in a bit of a pickle here. I think it's the I have not talked about Take-Two and the GTA effect. I kind of I think what I was talking about with Nintendo there, Bill, is kind of like the Take-Two GTA effect. I think that Take-Two can do no wrong right now. They reported a pretty weak quarter, and yeah, their stock's at 161 right now. Full disclosure, I'm short this stock, so I'm getting my ass handed to me. But, you know, I manage my risk. It's all good. Don't worry about me. But yeah, I am short this stock. I just want to be full disclosure with everything I'm talking about here. Yeah, I think that a lot of the bad things coming to Take-Two are being kind of swept under the rug because GTA 6 is coming in the next few years. I think to similar extent, we're seeing that in Nintendo, where they reported, they forecasted a very rough year, and shareholders shrugged it off because they're like, yeah, we don't own you for this year. We own you for Switch 2, right? Or we own you because of the new Mario movie. Or we own you because there's a Zelda movie coming, right? Or we own you because there's a new F-Zero coming. I don't know. Whatever it is. I think both those stocks have a buoy under them. The other thing I think happened, Microsoft buying Activision for $70 billion has created a floor to some of these developers. The ones with really good IP. So I would say Take-Two, Nintendo, and EA to a lesser extent have all kind of had a floor put to their stocks because Microsoft overpaid so much for Activision Blizzard. But yeah, GTA effect is real. Let's see. What are the other things people are asking me about? Yeah, Disney. Sorry. Disney stock has really kind of moved up and down with their Disney Plus efforts. So as their subscription service grows, the stock has gone up. As it wanes, stock goes down. I don't find it to be I don't know. Let me look at the financials real quick. Yeah, Disney's almost a $200 billion company. Forward PE of 21. Price to sales of 2. It's honestly not that expensive, but they have a decent amount of debt. $46 billion of debt. $6 billion of cash. I don't think they're not at risk of having a liquidity problem. Barely shorted. I don't know. Their profit margins aren't great, and I think it's stuff like the amusement parks doesn't really make a whole lot of money anymore, like profit wise. I think they're kind of a victim of the streaming space that they're in right now. So you see it with Warner, you see it with Paramount. Just it's a tough time to be a streamer, like one of these subscription services. So I think that's going to be the metric to watch there. On the chart, it does look like it's very close to filling this gap that came on earnings, or I think that was an earnings gap. So maybe technically it's resolved this whole move. I don't know. Let me see if I can find any signals worth watching. Nice thing about doing this at the end of the month is these monthly signals are useful. Yeah, so this was an inside month and down sell signal. So you see, this was this is the first bar of the pattern. Second bar went inside the range of the first bar, and then it broke down below that low. So you know how I'm mentioning that with like Nintendo, watch a breakout above this or below that, or with Nvidia. It wasn't Nvidia, it was some other chart. But I think it might have been Tesla. Let me see. Tesla had an inside month. There you go. So this is the setup, right? Big bar that stays inside of it. So Disney has that next bar. So big bar that stayed inside of it, broke down below the low. So when it dropped below 110, 33, 34 cents, that was your sell signal. So there's a technical reason why Disney was down 6% last month. That doesn't factor in fundamentals at all. That's just why we try to explain price movement with charts. The reason why we do that, 90% of stocks volume, any given stock, is coming from computerized trading, algorithmic trading, computers that are plugged almost directly into the NASDAQ, directly into the NYSE, that have like a few millisecond advantage over us. So they're front running us, basically. But computers need rules. And we have figured out some rules. And I shouldn't say we. My trading coach, Rob Smith, who has passed away last year, he figured out these things. And he put together a list of rules that he called the strat. I'm not going to get into what the strat is today because I could dedicate a whole episode to that, and I will. But it is the guiding force of my technical analysis. It's based on a few things. 1, stocks trade in a series of uptrends and downtrends across time frames. 2, stocks trade on actionable signals based on equilibrium breaks. So stock finds equilibrium, it breaks out of equilibrium. Or a stock doesn't stay in equilibrium, so the trend is still there. And then, the last thing is time frame continuity. We want to own stocks that are up on every time frame because we want to be in things that are going up in value. That's not that crazy to say, but when you see it put into practice in charts, it becomes a more valuable technique. So like a good example, let's go back to the Tesla chart. So Tesla's red on the year, right? So it's down on the year. It was slightly green on the quarter, so we don't have time frame continuity. It was red on the week. It was red on the day, red on the hour. It goes all the way down to a minute. You can use time frame continuity in all these different ways. I do believe that a lot of people like to think, oh, these are straight line resistance, or straight line support, right? I don't think horizontal support exists. I think it's really easy to look at a downtrend, though. And there's a downtrend. Series of lower highs. Series of lower highs. That's a downtrend. Series of higher highs. Series of higher highs. That's an uptrend, right? Nintendo. Nintendo's a perfect example. Lower low. Lower low. Or sorry. Higher low. Higher low. Higher low. Higher low. Higher low. That's an uptrend, right? So it's not you're not necessarily going to find support and resistance at flat lines based on past price. You need to look at how past price indicates the momentum of the price. And that's where these triangles or these trend lines come in. Sorry, these are like basic parts of technical analysis. I'll get into it in a bigger way in the future. Let's see what else. There's a couple other sectors people want me to talk about, but I'm going to spend more time before I do that. I will mention them, though. Someone wants me to cover alternative energy. So like global warming stocks or plays on global warming. I want to take a little bit more time before I put out a list. So today's sector of choice, we did semiconductors. So maybe next episode we'll do, the environmental stocks. Some people also want me to look at defense stocks. I'm not a huge fan of the defense industry, but I can look at them if you want me to. And then, there was another request for me to look at the space sector. Space is definitely a weird one because there's for-profit space companies. There's like 3 of them. And I don't know how many of them are traded. RTJD22 did ask a good question, though. Where are we at on the VIX? Great question. We're very low. Like, kind of scary how low things are. I don't trust this. So, the volatility index gives you a good idea of what the market is going to do on any given day. The higher the volatility, the higher the delta will be, the range at which the stock market could trade. And this doesn't necessarily mean up or down, but usually the VIX spikes when things are going poorly. So if you look at this spike here that went to $83, or sorry, not $83, 83 on the VIX, this was the lockdown. This was the shutdown of the world during COVID, which proved to be a buying opportunity or an option or a volatility selling opportunity. So volatility factors into how the options are priced for the S&P 500. So it will affect the price at which you can buy insurance or buy call options speculating on an upward move in the S&P 500. So the VIX is, I would say, very low, considering it's an election year. But then I think it went down today, kind of on news that, we got a little bit of certainty out of the New York Attorney General yesterday. And I think that may have affected the VIX today. Because the VIX hates uncertainty and likes certainty. So if you get certainty, the VIX will go down. If you have uncertainty, which, boy howdy, did we have uncertainty in March of 2020, right? Then you have the opposite, where it spikes and you see limit down days in the entire market. But yeah, I would say the VIX is quite low. That means that buying insurance on the S&P 500 is pretty affordable, which, by the way, S&P 500 is sitting here just a few dollars off of its all-time high, with a shooter and then a hammer week. Oh boy, that's going to be interesting to watch. We'll keep an eye on the S&P. There is no monthly sell signal or anything. There's no quarterly signal. And obviously it's up on the year. And this is an example of an inside year and up buy signal. So the S&P 500 has an active buy signal for the whole year if it stays above $47.93.30, which we are almost $800 above right now. So yeah, things are looking pretty good for the SPY and the broader market as a result. So yeah, pretty neat. Let's see. Going back to the thread, what else do people want? Give the people what they want. I'm in on... This is from Headrush. Headrush says, I'm in on the dip on DKNG. Sorry, I wanted to I branded this segment because I think it's funny to do that. I'm calling it Community Notes, taking a page out of the Shack Together book. But yeah, Headrush says, I'm in on the dip on DraftKings, DKNG. I have some older shares at $17 with a blended basis of 34. High hopes we're back into the mid-40s ASAP. And yes, I know they'll continue to get regulated to hell. Okay, so let's see. What are we talking about here with DraftKings? DraftKings is down on the year. It had a rough week. You're talking about a stock that was down 13.5 or 13.9% on the week, and the previous week it was down almost 8%. So yeah, it's down over 20% in 2 weeks. So first thing I ask is why? What happened? Why is the stock down? Right? And let's go look at the news for DraftKings. Why DraftKings? It's a Motley Fool article. I don't want to read that. Let's see. Massive news for DraftKings invest. Wow. Yahoo, what are you doing? DKNG. Google's no better. Fairly certain. Yeah, okay. Oh, okay. So there is cyber attacks on business. Fear on Wall Street that state tax regulators are going to start taxing online gambling. So that would decrease the amount of people gambling. So this is a stock that fell on a rumor, but clearly people are taking the rumor seriously. So now let's look at the fundamentals and see if I actually think it's worth owning. Spoiler alert, I don't really like gambling companies in general. This company is trading at 78 times forward earnings. So that's twice the forward multiple of Nvidia. Which I want to talk about opportunity cost again. It's trading at 4 times sales, 20 times book value. They were not profitable last year. They're expected to be profitable this year. They're growing revenues because they keep opening in more states, right? And Shannon Sharp is one of their dudes who shills it on his podcast. They don't have too much debt. Like they can pay off their debt. I don't see much of a reason to own it here. Outside of the revenue growth. If the revenue growth, if that's the biggest fear right now, is that the revenue is about to slow and they're barely profitable as is, I wouldn't buy it here. But, good luck to you. Also, hope is not an investment strategy. Like, hope isn't going to do anything. You can sit there and hope all day. It's not going to do anything. It's the fundamentals of the company, the news around the company. What the company does is what's going to make your stock go up or down, not hoping. But yeah. DraftKings. Let's see, what else do people want? This person asked for AMC. You know how they're like, if you don't have something nice to say, don't say anything at all? Isn't that like a saying? Did your moms ever teach you that? No? Anybody? Anyway, here's the... Yeah, you've heard it before. I mean, I really don't have anything nice to say about this stock. Let me just pull up a long-term chart of it. There you go. Do I need to say anything? Can I just use this? Can I just point at this? Like, here. Like, this is... like, What do you think of AMC stock? I don't. That's what I think. I don't think of this stock. Any questions? No? Okay, cool. Sorry. I'm really trying to be nice here and not crap all over someone's investment thesis. But yeah, I don't think there's anything I can say about AMC that the people who buy AMC would believe. I've never seen a bigger collection of tinfoil hat people in my life. It's kind of stocks like these are the reason why this show exists. I'm trying to educate people to understand that there are fundamentals underlying the companies that they invest in, and they're not just lottery tickets. So in the case of AMC, you have been diluted. I want to say it's like 5 times in the last however many years, but it's also like I don't have the exact numbers, so I don't want to opine on the just how much dilution has occurred, but you don't make money if every time the stock goes up, the CEO issues more shares to dilute it. And they still have a bunch of debt. AMC probably won't make it through 2026 based on the amount of debt they have, unless idiots keep buying the stock and giving the CEO an opportunity to raise more money. And honestly, this is what's going on at GameStop. This is what happened over at Tesla in 2012 and in later years too. Like, when companies are on the verge of bankruptcy or about to go under or maybe about to succeed, issuing shares can be very useful. But when there's a pattern of every single time that the stock goes up that your CEO is issuing more shares, maybe there's a bigger thing going on and you should avoid it. So yeah, if you look at, there's the GameStop stock in the same time period. And they've issued shares as recently as, last week. But you're down over 90% right now in NVIDIA. You're not down 90% in GameStop. You're down. You're definitely down. You're not down 90%. And I wish less people got tricked into this. Because it's a nominally cheap stock. Blah, blah, blah. But there is no... let me just see how much debt they have. Yeah, like $9 billion of debt and only $600 million of cash as of like a few months ago. That's not great. And they're not profitable. Their net income isn't positive. They were profitable last year. Barely. Trades at a discount to its sales. I get that. Discount to book value. And the short interest is around 20%. But yeah, that's AMC. Don't want to end on that kind of wet fart, though. That's lame. Who wants to do a thought experiment? Who doesn't love a good thought experiment? I know the kids love thought experiments. So I want to go back to the concept that we brought up earlier. I don't know if... Here we go. Boom. Opportunity cost. Opportunity cost is what you could have made if you bought something else as opposed to what you did buy. So each episode, I'm going to pick a different stock and I'm going to ask the question, what if I put this money that I put into a stupid Tesla Roadster 2.0 pre-order, what if I put that money into this stock on the same day? What would happen, right? So what should we pick? Let's pick NVIDIA. Let's get me real mad. Let's pick NVIDIA. So here we are. NVIDIA. So I pre-ordered the Tesla back in December of 2017. So let's just say Nvidia was $50 that day. Obviously split adjusted, whatever. So we have $250,000 divided by 50. I could have bought 5,000 shares of Nvidia. What would those be worth today? Stock's about $1,100 a share right now in after hours trading. That would have been $5.5 million. Instead, I gave Elon Musk a interest-free loan for 7 years. But yeah, it could have been what it could have been was $5.5 million. And that is the definition of opportunity cost. I thought that would be a fun way to end the episode, but it's proven to make me even sadder. But, yeah. So whenever you're feeling bad, or you think that you don't know what you're doing, just know that I'm not an idiot, but I certainly feel like one every time I think about my Tesla Roadster pre-order. A car that still has not been delivered, and we have no idea when it will. But yeah. So I think that's going to do it. I don't know. Does anyone have any other questions? Oh, thank you. Thank you for the follow, Left High Kick. You came just in time to hear about this horrible, horrible opportunity cost. But yeah. Anyone have any other questions? Comments? Yeah. It hurts, man. It does not feel good. Also, like, Elon Musk, he was a douchebag in 2017, but not as big of a douchebag. So, yeah. Think about all that's happened from 2017 to now. But yeah, that $250,000 that Tesla's just been sitting on for 7 years could have been $5.5 million of Nvidia stock. And that makes me a sad panda. But yeah, any other questions before I get out of here? Because I think this is a natural time to kind of wrap up the show, right? Oh yeah, a question. At least we have a comment here. Lesson 1, don't invest in tennies. Greg, what is your question? Or are you done? Are you saying I can be done? I don't understand. Just yes. What is that? What does your yes mean? I'm done? That's nice. But yeah. That'll do. I think I hit a lot of people's questions from the chatty. Someone asked about Micron. You know what? I'll hit Micron real quick. Micron's interesting. It's in the semiconductor space, but I kind of leave it out when discussing the other ones because it's not really... It's more on the storage and memory side, which is largely commoditized these days. But we are talking about a very, very good-looking stock chart here. It's not even that expensive. It trades at 17 times forward earnings, 10 times trailing earnings. I think that the problem is that they did so well for years that they're lapping some very difficult comparisons, which will maybe create an opportunity to buy the stock. The one thing I'll say is that this sector tends to be far more cyclical than other semiconductors, because it's like you see this inside of computers, laptops, phones, anything that uses SSD affects the demand for Micron products. But there are very few players in the space, so it is a good one to own. I don't know if I would buy it here, given where we are. Like I said, like there are some really good things there's some good companies in the semiconductor space right now. You know, we got AMD, you got ARM, you got Micron, Qualcomm, you know, Nvidia. There's a lot of really good looking charts in the space. And then there's Intel. But yeah, I don't know. I wouldn't buy Micron here, but if you already own it, congratulations. You're probably up a lot. You know what I mean? And Greg asks a non-finance related question. So thanks, Greg, for staying on topic. Do you think the Roadster will be better or worse than the Cybertruck? Is it possible for anything to be worse than the Cybertruck? Like, seriously, Greg? You really think? You think that something could be worse than the Cybertruck? I think that the Roadster, the real question is the Roadster vaporware? Is Roadster 2.0 more vaporware than full self-driving? That's a better question. But, yeah, the Roadster will be better. Maybe the Roadster will be Tesla getting back on track. Probably not, but maybe. But that was a terrible question. Let's see. Oh yeah, I was gonna do this too. I'm just gonna we cover a bunch of different earnings on the site. I want to just give one stock its flowers each episode. So this week's winner of I'm gonna call it the best earnings quarter report that I heard all quarter, Nvidia. They beat on revenue, they beat on earnings, they increased their guidance for revenue and earnings. And yeah, all roads lead to Nvidia right now. Every single conference call we listen to, Facebook, we're buying chips from Nvidia. Microsoft, we bought chips from Nvidia. Apple, we're working with Nvidia. Google, we're working with Nvidia. Amazon, we're working with Nvidia. Tesla, we're working with Nvidia. So, yeah, I do think Nvidia had the best quarter by far, and they're executing extremely well. And these prices are absurd for the chips that they're making. You're talking like $40,000 for one of these chips. And the margins are insanely high. They're making $30,000 of profit on a $40,000 chip. And they'd probably be making more money if they can make more of them. So yeah, I think Nvidia had the best quarter. They're going to win my best quarter of the month. That sounds really dumb. Best quarter of the month. Best report of the month? Best quarterly report of the month? I don't know. We're still workshopping things here, folks. So yeah, that'll do it. I think that's it. I did the show. I hope you enjoyed this. This will end up on YouTube over there at the Shacknews VODs channel. Yeah. It's not that you came in late. It's that you asked a question that had very little to do with finance. But you did ask a question about Tesla, so I don't know. Whatever. Beggars can't be choosers here. You're like one of my 4 viewers that came to the live stream, so thanks. Whatever. That's it, though. I'm done, right? I don't have to do this anymore. Come back in a month. Right? Anyone else in chat has anything that they want me to look at before I go? Otherwise, I got a big ass salad to order. Yeah, I'm not doing that. It's garbage stock if you want to look at it. It's not even called that anymore. It actually never was called that as a stock. But here you go. I don't understand Kappa, so you're getting it. I don't speak Kappa, so you're getting analysis of this stock now because you asked for it. It was up on the week. It's down on the month, inside month. So next month, if you want to short this, because God, you don't want to go long this, but if you want to short it, if it drops below the low of May, 42.03, that would be an active sell signal on the year. It's a red quarter too, so it's looking like we have time frame. Oh no, we don't. It's up on the year. What the hell's wrong with this world? This stock is up 179% this year. Yeah. I think that means it has a long way to go down. So, yeah, I don't know. Maybe I'll even short it. 42.03 would be the price at which, if it breaks down below it, that would be a short signal. And then just I'm just kind of interested now because you asked. It's not that heavily shorted. Only 8% shorted. 75% held by insiders. Oof. And I don't think they have much money. So yeah, this company they're losing $100 to $400 million a year. And they have 200 some million in cash and 50 million of debt. I would rather own AMC. I have a short position in Take-Two that I mentioned earlier. It's not going well. I'm down on it. Yeah, Take-Two had a hell of a month. See if there's any other monthly signals that we can look at before we go. Apple had a month. ARM Holdings had an inside month. So if you're looking to buy into ARM Holdings, just from a trading perspective, a breakout above 125.98 would be a buy. A breakdown below 95.24 would be a sell. I know that's a big range, but it's been a volatile stock if you look at these last 4 months. Salesforce had a bad quarter. It was down. Salesforce was down 20% in a day yesterday. I mentioned Dell earlier. GameStop had a very, very good month, despite selling off quite a bit from it. No actionable signal on the month. The GameStop price level to watch is 27.65 to the upside. If it breaks out above that, you're going to have a buy signal on the yearly chart, which we already have, and we saw it shoot up to almost $60. I think it hit $80 in the pre-market one day a few weeks ago. And then if you're trying to short GameStop, Godspeed. Below $11.82, you would have an active sell signal on the yearly chart. And these would be actionable signals that you could use throughout the entire year. And you would want to look for like a monthly or like a weekly signal. But yeah, if you're looking at GameStop, you're talking about a stock that's green on... This is a time frame continuity stock. It's up on the year. It's up on the quarter. It's up on the month. It's up on the week. Barely. It was up on the day. So you have time frame continuity to the upside. So if you see a signal, especially a long-term signal like getting above 27.65, this thing can really get going. So yeah, keep an eye on it. Full disclosure, I own GameStop. And I own call options in GameStop because I'm a little bit of a degenerate. You know, I take a little bit of speculation. It's okay to speculate. Let me just end that with this. Like, everyone has their portfolio, right? You have your ETFs over here. You have your mutual funds over here. Whatever. Take 10% of your money and just take some chances because occasionally you'll get a winner like a Tesla or a Nvidia or, you know, some other smaller company even. Nintendo. You know what I mean? Like, they're just, I don't know if Nintendo's really speculative, but like, if there's a company that may not have the best fundamentals, but you think is interesting, you think is in a situation where a short squeeze could occur, and we'll get into short interest and all that in a future episode. I just think it's okay to take some risk as long as it's calculated. You know how much risk you're taking, and you know how much you could lose, and you define it. And the most important thing, have a thesis. Understand, this is why I'm buying this thing. And if the thesis is disproven by reality, get out. And if the thesis is proven true, stay in, maybe even add. And then, yeah, just don't go all in on anything. Diversify your portfolio. We can get into how to do that. If you're just starting as an investor and you don't already have like a portfolio built, pay off your debt first. Like, if you have credit card debt, pay off your credit card debt before stockpiling into a Robinhood account and trading options. The better investment for your life is to pay down high interest bearing debt. So once you do that and you have some money lying around, you can put it in an E-Trade account, or I don't really recommend Robinhood. I'll give them credit in that they have democratized shareholders a bit, but I also think they're like one of the biggest problems with this market right now. They've gamified it to the point where people think they're just playing a game, or they're just using another gambling app like DraftKings. But yeah, I worry that people are not taking this seriously enough. And if they did, they could actually make money. So yeah, just manage your risk, I guess, is the thing I would like to leave people with today. And thank you for watching. If you like this, if you made it this far into this video, if you're watching it on VODs, like, give us a like, a follow, a subscribe. That stuff helps us a lot. We have a lot of different platforms that you could support us on. Yeah, I just realized something. I have an opportunity to end this stream playing Bubbletron, so I'm going to. So another way to support us at Shacknews is to play our first game ever. It's called Bubbletron. You combine 3 ideas, hit the market, and you get your money hit. And there's a new opportunity every day. So if you're a degenerate gambler, you can use this somewhat like a slot machine-like game and not lose real money. It's a pretty good way to get started. Not really, but, you know, I'm here to promote Shacknews stuff. So let's see. Maybe like a war profiteering porn for those hard to reach places, right? Then you just hit the market. Damn, I really thought that was going to be worth $1 trillion. Anyway, that's one way to support us. Thanks for watching. Bubbletron.com is free to play. No sign up required, no download, nothing. And new parameters every day. So yeah, cool thing to check out. Thank you for watching. And I'm going to get out of here. But really appreciate everyone who did stop by, ask questions in chat. Thank you to everyone who asked questions in the chatty. I'll probably do that for the next episode too. It's like a few days before we go live. I'll have some material. Maybe I'll do it like a week ahead of time, because there were some like more in-depth research questions that I didn't really want to answer on this first episode that I'll get around to. But I do think like talking about one sector per episode, I think makes sense, like in that segment. Obviously, anyone who has requests, we can look at stock charts for that. And yeah, you can follow us here on Twitch. Subscribe to us over there at Shacknews VODs and Shacknews YouTube. And Shacknews interviews on YouTube. Social. I think there's another. And then there's obviously the website, right? Shacknews.com. Looks like we're still on some kind of delay though. What is talking? What is someone is okay. Just making sure things are good. I think we're good. Yep, we're good. Cool. I don't know how to sign off of shows anymore. I'm really bad at this. If you're listening to our podcast, it's the same thing over there. So I don't know. What does Jim Cramer say? There's always a bull market somewhere, right? Isn't that his thing? I don't know. What should my saying be? I don't know. I don't have one. But thanks for watching. Yeah, you know what it is? It's manage your risk. That's going to be my motto. So manage your risk out there. And there's a reason why I'm doing this at the end of the week. Because I don't want people just to take my advice and run and act on it. Like, take some time. Consider your own investment objectives. Consider your own risk tolerance. What your goals are. But I hope that I at least gave some people motivation to not just buy things because YOLO. Like, actually think about what you're putting your money in. You work hard for money. Don't just piss it away on stupid stocks. Like, think about it. Don't just gamble. If you're going to gamble, be a real degenerate and gamble on WNBA games. Anyway, that's all. Thanks for watching, and I'll see you next time.